All right, everybody, welcome back to Strongman Personal Finance. Today we're going to talk about mutual funds. So, what on earth is a mutual fund? What is it? What do they do? What's the purpose? Well, ladies and gentlemen, I made this little diagram for you to help you understand, all right? Now, we're starting at the top left where you see that crowd of people. That's our investors, all right? From the top left, we're going to move down to the middle where it says fund managers, and then we're going to move down again to where it says investments, okay? Then we're going to move back around, if you follow the dividend capital gains arrow, back to the investors. Here's how a mutual fund works. So a bunch of people, they decide to pool their money together and give that to a fund manager, right? So everybody pulls a bunch of money together and they give that to one small group of people. That small group of people are called the fund managers. Those fund managers then take that money from all the investors and then they purchase investments, all right? So instead of one person buying a bunch of investments, you have hundreds, thousands, millions of people pooling their money together, giving it to a select group of people to manage their money and purchase investments on their behalf. So, like I said in the top left, you have the investors. They give money to the fund managers. Those fund managers buy whatever the mutual fund has been designed to buy. All right. You can have a stock mutual fund. You can have a bond mutual fund. You can have a mutual fund that invests in alternatives. You can have a mutual fund that invests in everything at once. All right. There's all different types of mutual funds. A mutual fund is not just stocks. You can buy basically anything in a mutual fund. You can even invest in real estate through a mutual fund. That's called a real estate investment trust. All right. So the investors, when they give the fund managers the money, the fund managers pick whatever investments they want according to the fund's investment strategy. And then over time, the investors reap rewards from those investments in the form of capital gains and dividends. Now, mutual funds can be actively managed or they can be passively managed. What is actively managed? All that means is the fund managers are allowed to buy and sell whatever investments they think they need to buy or sell to maximize the gains of the mutual fund. Passive management is when the fund managers have to buy a certain amount or a certain type of investment, and then they do that to track an index. For example, a passively managed S&P 500 mutual fund. The purpose of a passively managed S&P 500 mutual fund is to track the S&P 500 index. So they achieve their goal by getting the investment's returns, the mutual fund's returns, as close to the performance of the S&P 500 as possible. Now, in an actively managed mutual fund, those fund managers are actually trying to beat the index. So if the fund managers are trying to beat the S&P 500 index, they may only invest in, 100 stocks in the S&P 500 that they think are going to beat the index overall. So victory for an actively managed fund team is to beat an index, whereas victory for a passively managed fund, their victory is to match the performance of the index as closely as possible. So here I have some categories of mutual funds. All right. You got mutual funds that only invest in stocks, McDonald's, GM, Ford, for example. You have other mutual funds that only invest in bonds. You have mutual funds that invest in both bonds and stocks. And you have mutual funds that invest in short-term debt, such as money market accounts. All right. So equity, bond, balance, short-term debt mutual funds, they can all either be passively managed or actively managed. All right. You have indexes for equities, bonds, balanced, everything. There's an index that matches almost every single type of category of investment. And like I said, just to reiterate, if it's actively managed, the mutual fund managers are trying to beat whatever index or benchmark they're competing against, whereas passively managed mutual funds try to match the index as closely as possible. So there's advantages and disadvantages to investing in mutual funds, all right? Some of the advantages, you get instant diversification. If you don't have much money to invest, you can invest your money into a mutual fund and get broad exposure to the market. All right. If you think about it, if you have a couple $100s, you can only buy a certain amount of stocks by yourself. But if you pool your money with a bunch of other investors, you can give the fund management the opportunity to buy way more stocks. And then you get exposure to all those stocks because you own a piece of every one of those stocks when you invest in a mutual fund. You own a part of that mutual fund. Kind of like when you buy a stock, you own part of a company. All right. Another advantage, completely hands off. You give the fund managers the money, they invest it on your behalf. Yeah, you got to pay them a little bit of money, but you don't have to worry about it. You read the prospectus, you understand what the mutual fund's going to invest in, you hand off the money, and somebody does it for you. It's extremely convenient. So you don't have to sit there watching the stock market every second of every day. You know, oh my God, what's happening with my stock? Oh my God. Don't have to worry about it. Somebody else is doing that for you. And they can usually act a lot faster than you can. Another advantage, specialization. There's all different types of mutual funds, like I said previously. You got mutual funds that invest in stocks, large cap stocks, mid cap stocks, small stocks. You got mutual funds that invest in treasury bonds, corporate debt, junk bonds, healthcare sector, IT sector, whatever. You can get all sorts of specialization when you invest in mutual funds, all right? It's going to be a lot harder for you to do that as an individual investor. And finally, you can buy partial shares of a mutual fund. So if a share of a mutual fund, let's say it costs $35 a share, and I invest $50, well, I can actually buy a share and roughly a share and a half of that mutual fund with my investment. So you don't have to buy specifically one share at a time. Whatever you're investing, you're actually getting full shares and partial shares. So you don't have to wait to fully buy a share. All right. Hopefully that makes sense. Some of the downsides. You got to pay people to manage your money for you. Some mutual funds will charge you out the butt. Can't say other words because they're bad for YouTube. They will charge you out the butt to manage that money for you. Other mutual funds won't. So you need to really be careful when you're analyzing your mutual funds so that you're getting the best deal for your money as possible. But no matter what, you're going to have to pay somebody to manage your money for you. Nothing's free, buddy boy. All right. Another downside. A lot of actively managed mutual funds underperform the market. I would say, I think it's like 78% of them underperform the market. So you may think that you're investing money with some pros, but a lot of the times these professionals fail to perform. All right. So that's one of the risks you take. Your fund management team may suck completely. And if they do, you're not going to make as much money in an actively managed fund as you would have had you invested in an index fund. All right. There's also sales charges. Now, these can be avoided, but if you're going through a financial advisor or you pick the wrong mutual funds, you can actually pay upfront sales charges, recurring sales charges, and then sales charges when you sell the mutual fund. So your returns can be erased or severely reduced depending on what type of mutual fund you're buying. So it's best to avoid mutual funds that charge you significant sales charges on top of management fees. There are a lot of those out there and they'll screw you. All right. Another downside, you may buy into a mutual fund that has great management, but that management can change. One manager may not stay in a mutual fund for a long time. And if you get a new manager that sucks, well, you could be in a lot of trouble. That fund may do good for a couple of years, and then it may start underperforming significantly because the new guy doesn't know what he's doing. All right. And finally, they're slightly illiquid. So when you buy a stock, you can buy a stock at any time of the day. However, a mutual fund, you can only buy it at the end of the day or the beginning of the day. So if you want to sell your mutual fund shares, well, you're going to have to wait to the end of the day or maybe a day or two for the sell to process. So they're not hugely illiquid, but it takes some time for you to actually sell or buy your shares in a mutual fund. So here I made a list of common terms that you're going to see when you're looking at investing into a mutual fund. All right. First one is net asset value, or the NAV. And basically all that means is that is the price, that is the market value of one share of that mutual fund that you're looking at buying. The net asset value changes every day. Every time the market opens and closes, the value of that mutual fund and the value of each share changes. Prospectus. The prospectus details the objectives, strategy, and performance of the mutual fund. You need to read this before you invest in a mutual fund. This document will tell you everything you need to know about the mutual fund. Who are the managers? What kind of things are they buying? How diversified are their investments? What are the objectives of the fund? You need to read this. It's a big document, but if you don't really understand what you're investing in, you could be giving your money to a bunch of bozos that don't know what they're doing. So you need to read this document to really understand what you're buying. Shares. A share is a partial ownership of the fund. The price of a share is the net asset value. You own a part of the mutual fund. You own a share in that mutual fund when you buy into it. All right. You can have one share, you can have a share and a half, You can have a share in 3/4. You can have 100 shares. However many shares, however much money you invest is how many shares you get. And your goal is you hope that those shares appreciate in value. And they appreciate in value as the mutual fund's value and the underlying investments go up over time. That's what you're hoping happens. Distributions. So every year, usually at most every year, you're going to get distributions from the mutual fund, which means the mutual fund is actually going to pay you cash. The things you get paid out with dividends distributions are interest, dividends, capital gains. All right. You have a choice. When the mutual fund pays out this interest, dividends, or capital gains, you can choose to either reinvest that to help compound your growth, or you can take that as cash money and put it in your bank account. So, if you think about it, if you had $1 million in mutual fund and every year they distributed 4% of their value, well, you're getting 40 grand a year of cash for just sitting on your butt and doing nothing, right? Now, when you're retired, you might want to start using those distributions to fund your lifestyle, your retirement. But when you're actually growing the value of your investments, it's more likely or more recommended that you actually reinvest those distributions. And no matter what, if you take those distributions as cash or you reinvest them, you're going to have to pay some taxes on those every year. So when you buy mutual funds, you need to set some money aside every year to pay taxes on those distributions. All right? Expense ratio, very important. This is how much the management team is charging you every year to invest your money on your behalf. Every year, you got to pay these people money. That's the expense ratio. So if you have a high expense ratio, that's going to significantly eat into the gains the mutual fund is getting on your behalf. You need to find mutual funds that have low expense ratios, generally. If you do find a fund that has outstanding performance, then maybe you can pay a little bit more money every year. But in general, most funds usually perform about the same, roughly. And a lot of the times, the best deal is to find the mutual fund with the lowest expense ratio. 30-day SEC yield. This is tied into distributions. So every year, that mutual fund is going to be distributing some kind of income to you, whether it be in the form of interest, dividends, capital gains, whatever. And basically, all this does is this calculates your annualized yield for how much you're going to be distributed every year. So for example, let's say in 1 month, the mutual fund distributes, 1% of its value. Well, the 30-day SEC yield would be 12% because over 1 year, if that mutual fund were to pay out 1% per month, you would get a 12% yield for the year. All right. So this 30-day yield annualizes your income from the mutual fund. Capital gains. Basically, every time the fund sells a stock or a bond for a gain, they owe taxes on that. All right. And they have to pay out the vast majority of those capital gains to you. So you got short-term capital gains, long-term capital gains. We'll talk more about those later, but it's all about timing. All right. And finally, total return. Mutual funds make money, or you make money from mutual funds by the dividends they pay out to you and the growth of the value of those shares year over year. So the total return, how much you're actually making, is a combination of the appreciation of the shares of the mutual fund and the dividends they pay out to you. So you may be wondering, all right, Chris, what mutual fund should I buy? Well, guess what? I can't tell you. It all depends on you. What is your time horizon? How long do you need to invest this money for? When do you need the money? What's your risk tolerance? How much risk are you willing to tolerate in the markets? What is your tolerance for fees? I recommend you pick funds that have low fees, but maybe you want to pick an actively managed fund that you think can outperform the index or the index funds. Well, a lot of times those funds are going to charge you higher fees. Management. This is actually one that everybody can look into, all right? How stable is the management? Does the mutual fund have a management team that's been there for a long time? And how well has that management team performed? If the management sucks, you don't want to invest in the mutual fund. If the management's good and they've been doing good for a long time, well, you may want to consider investing in that mutual fund, all right? Now there's a lot of places where you can buy mutual funds. Me personally, I'm a huge fan of Vanguard, all right? Vanguard's great. They have extremely low fees and they perform pretty well compared to other mutual funds. So even if Vanguard performs or underperforms other mutual funds by a little bit, well, the mutual funds they have are extremely cheap. I'm not paying that much money every year in fees. So even if I underperform other people, in the long run, I'm actually stomping them because I'm not losing a lot of my gains to management fees. All right. Another great one is Fidelity. Fidelity, it's kind of similar to Vanguard. They offer hundreds, thousands of different types of mutual funds that you can buy into. All right. Vanguard doesn't have as many mutual funds, but their fees are extremely low, and I like them, and I've always invested with them. But you don't have to invest with Vanguard. You can do Fidelity. There's T. Rowe Price, BlackRock. There's all sorts of different places you can buy mutual funds. The key things to keep in mind are what I have listed here: your time horizon, your risk tolerance, low fees, stable management. Those are all things that you want when you invest in a mutual fund. So here I have an example of a mutual fund. This is the Vanguard Target Retirement 2060 Fund. The goal of this mutual fund is to get somebody who wants to retire in 2060 to their goal. So what the mutual fund does is it actually invests in other sub-mutual funds. It invests in the Vanguard Total Stock Market Index. It invests in the Vanguard Total International Stock Index, Total Bond Market Index, the domestic one, and the International Bond Index. And what this fund does is as you get older, as the fund approaches the year 2060, it trims your stock holdings and it increases your bond holdings. So at the beginning of the fund's life cycle, you're invested heavily in stocks because those stocks are to give you potential for extreme growth over time. Whereas you get closer to retirement, it puts you more in bonds, so your portfolio fluctuates a lot less. Now, this is what I like to call an all-in-one mutual fund. You literally just put your money in it, and the fund managers do all your asset allocation, all the planning for you. You don't have to worry about anything. You put the money in, and when you get to the year 2060, you have a mutual fund that's perfectly suited for your retirement goals. All right, and now we have the closing thoughts. Thought number one, closing thought number one. Please like and subscribe. I make these videos every single day, and I enjoy doing them. And I want you to see them every day, and you can do that by liking and subscribing. All right? Thought number two, day trading is a terrible idea for the average American. Don't do it. Do not day trade. Don't do it. It's bad. Buy mutual funds instead. Just trust me, okay? Mutual funds can also be bought for incredibly low fees. There are many mutual funds out there that charge you next to nothing, and they allow you to invest in broad swaths of the market. All right? They're a great deal. They offer instant diversification, and they're freaking cheap. It's a good deal. Invest in mutual funds. Don't day trade. All right? Another closing thought. Passively managed mutual funds generally outperform active funds. Remember, actively managed funds are funds that try to beat whatever index they're competing against or they're benchmarked against, whereas passively managed mutual funds try to match the index that they're benchmarked against. All right. These fund managers are pretty intelligent. All right. Even the guys that manage active funds. And their goal is to beat the market index. They want to give a better return for their investors than the market does as a whole. So they're trying their best. They're buying what stocks they think are the best stocks, and they're getting rid of stocks they think suck. All right. Even then, almost 78% of the time, passively managed mutual funds that just try to track the market as a whole, they tend to do better than active funds. So even these professionals that went to Harvard or Yale, they're not doing as good as the market on average, which makes you, wonder, well, if these, incredibly intelligent guys can't beat the market, what makes you think that you can beat the market? You most likely can't, which is another reason why you shouldn't day trade, or gamble your life savings on shorting penny stocks or some other ridiculously dumb investment, all right? Passively managed funds do pretty well, and I recommend you invest in them, all right? Another closing thought. You don't need to be rich to invest in broad swaths of the market, all right? You can buy one share of a mutual fund that has a diverse, set of investments, and you're exposed to all those investments. You put in, a couple bucks, and boom, you have exposure to a huge part of the market, which is awesome. You can't do that by yourself. Mutual funds allow you to do that. And then last but not least, there are many fire and forget options. Now, I love investing, all right? I've loved it since, I was 15 years old and I read The Automatic Millionaire by David Bach. Love it. Even then, I don't think I can beat the market. I don't think I know enough about analyzing individual stocks to know which stocks are going to do well or do the best over time. So what I do is I invest in mutual funds that are fire and forget. All right. These are like, target retirement funds or balanced mutual funds. These are mutual funds that literally do everything for you. They'll have a target date, and when they're new, they'll invest mostly in stocks, and they'll allow your money to grow over time. And then as they get closer to that target date, they start selling those stocks for you and investing those in bonds. All right. It's super easy, and you don't even have to think about it. It's great. There are so many great mutual funds out there, and they are so superior to day trading or trying to, pick the next hot stock. That's just ridiculous. Don't do that. All right. So I hope you enjoyed this video. I implore you to like and subscribe, and I'll be posting another video tomorrow. You guys have a wonderful night. Cheers.